again, everybody. This is John Norris at Trading Perspectives. As always, we have our very good friend, Sam Clement. Sam, say hello.
Hey, John, how are you doing?
Man, I'm doing okay today. I'm actually absolutely doing okay. And, I'm doing okay because it seems like the economy is doing a little bit better. The markets seem a little bit happier than they were. I mean, heck, they've been happy for a while. And some of the economic data has been okay. But, Sam, I'm sitting there taking a look at things and wondering, is a shoe going to fall somewhere? Is there any potential that this is just too good to be true? And you told me something. You read a report yesterday that said that maybe things aren't maybe quite as good as what we would like for them to be.
Yeah, and I think a sore spot for people is looking at mortgage delinquencies and just a housing crisis. And are things getting worse? And are we going to have another 2008? And obviously, some of the data is already worse than 2008. But I saw some interesting data from Black Knight, the kind of housing data organization, and it says mortgage delinquencies increased another 20% in May to hit the highest level since 2011.
Wait a second. That's the highest level since 2011?
Yep, 9 years. And that's another 723,000 homeowners becoming past due on their mortgages in May. So that's kind of that's a hard statistic to ignore, if you ask me. I mean, that's one that came across the TV, and I had to look it up myself because that was pretty shocking.
Yeah, that is a pretty big number. And, that Black Knight report did get overlooked pretty much. There's a couple of small headlines on the Bloomberg and even the fact set yesterday. But in terms of people talking about on the television and Kramer and all the usual suspects, not a lot of talk about that. And that is a big spike in people not paying on their mortgages. And a matter of fact, the percentage of people even paying at all on their mortgages that are in forbearance, at least, has shrunk, dramatically. And that was part of that report that I found to be maybe as scary, if not a little bit more scary, as number of people that have just given up trying to pay anything. And so here we have this big spike in delinquencies on mortgages, and it's not to 2008 levels yet, but even so, when you start talking about the highest in a decade or thereabouts, you have to start getting a little bit worried, particularly when we're dealing with an economic time, Sam, where no one's really been through this. And try to draw a comparison to 2008. I don't know. It's kind of like, what should we be looking at? Is it mortgage delinquencies or is it something else?
And that's a good question, but I think starting out, do you just look at some of this data? And yes, it's not 2008. We're in a completely different scenario. This wasn't started as a financial crisis, but some of the results are probably going to be the same as 2008. I mean, there's I think a little over 2 million people missing mortgage payments at the end of March, and that spiked to over 4.3 million now. So, I mean, that's some scary numbers.
4.3 million. Mortgages were
4.3 million homeowners. 4.3 million homeowners past due on their mortgages or in active foreclosure. So that includes those who are in forbearance, who have missed scheduled payments as part of their plans. So 4.3 million. Serious delinquencies are also on the rise, up by more than 50% in the past 2 months. So, I mean, we're seeing all this housing data. People are not paying their mortgages, whether it's they have this. They don't have money or whether they just have what they see as bigger needs. But my fear is once this $600 unemployment rolls off at the end of next month, what's it going to look like then? I mean, this is people that can't pay their mortgage even with this $600 coming in. And maybe some of these people aren't getting the $600, what have you. But you got to assume some of these people that aren't paying it are still getting their $600, and some people who are, say, barely paying it right now, and so they're not included in these numbers yet. When their $600 rolls off, and if they don't have a job, what's it going to look like in 2 months from now?
Well, Sam, you're hitting on a very good point about the money running out at some point. But then also, I also want to point out that the Black Knight report is just on mortgages. It's nothing to do with rental payments. And I wonder how many people out there are late or missing on their rent payments, and what does that mean for landlords, and what's going on in the apartment industry. So you're seeing spikes up here. It suggests that people are strapped, and perhaps a little bit more strapped than some recent economic data would suggest, because we saw that big spike in retail sales numbers for the month of May, up 17.7%. The Bureau of Labor
Right.
Statistics said that the economy created some 2.5 million jobs or thereabouts in May, although they did qualify the bejeebers out of that. But the thing that you and I have talked about, and the thing that leaves me a little bit worried or scratching my head, you're absolutely right. What happens at the end of July when that additional $600 per week that the federal government is chipping in for unemployment insurance, when that runs out? What happens when the PPP money, from the business owners that got the money, what happens when that runs out? Because I think that was only scheduled to last for like 8 weeks from whenever the loan was funded. And when that runs out, a lot of these shop owners, these mom and pops, going to be able to keep their people on. I've read some very good articles, primarily about restaurant owners or coffee shop owners or mom and pop retail, saying this is the only thing that's keeping me with my payroll right now. And as we open up, if I've only got 50% of the revenue, because that's all the number of people I can leave in the store, I'm not going to be able to keep everyone on. So I think, and you and I have talked about this, our investment committee has talked about this summer is going to be really telling as we have some of these programs kind of dry up or kind of end, whether or not we need to continue on with the programs or just let the economy run its course.
Yeah. Yep. I mean, we're having a few people starting to kind of push back on the debt levels and what that looks like. This is going to start to roll off and maybe some of this data starts to get worse. Actual foreclosures are at an all-time low, I think, in the past 20 years just because they've pretty much been halted right now. So people who are in foreclosure, that's pretty much been halted. But say they start to foreclose on houses again and we start to see some grim, ugly data coming out and, maybe this doesn't trickle into mortgage-backed securities, but this is individuals' livelihoods and their houses. And we start to take houses from people. It may change some people's perspectives as far as what kind of money we're throwing at this.
Well, you're absolutely right. And the reason why we perhaps have not been public about talking about V-shaped recoveries or even making really any sort of major comment about whatever shape the recovery should be is because all these question marks that we have out there right now. And, there's some firms out there saying, I believe it was BlackRock recently that said strong V-shaped recovery. And I just kind of wonder whether or not their analysts and their investment committees are thinking about the same things we are. What happens when PPP runs out? What happens when the restaurant can only have 50% of the revenue? What happens when the unemployment insurance goes back down to normal levels and we aren't back at a high enough level to support all these additional workers? Because, how many people have lost their jobs? $30 million, $30 to 40 million? And I have read, depending on the source, that the PPP program has protected anywhere from 16 to 30 million payroll jobs. So when that money runs out, or all of a sudden the 8 weeks is up, and the business owner doesn't have that in the checkbook any longer, will there be enough revenue from actual business activity to keep everyone on? And that's the real question mark. And that's what, I'm worried about. I think that's what you're worried about.
Yeah.
And particularly when you start seeing the types of numbers that Black Knight reported on yesterday, for already seeing a tick up in delinquencies and mortgages before we have these programs run out. Sam, the numbers could get real ugly real quick. And would it be just a death spiral from there, a domino effect of bad economic activity? What are your thoughts?
Right. The analogy I've heard used that I kind of liked is the economy has become a kid that can't really swim, and we've put some floaties on it, and it's able to kind of sustain itself kind of right now. Still probably not as great as we would like, but, as of right now, come the end of next month, and those floaties are going to be taken away, and we're going to have to see whether the kid can start to float again on its own. So it's hard to tell right now. With how much money the Fed has been pumping into the economy and how much the government has backstopped small businesses and like you mentioned, the PPP program and just all of this, just cash thrown at the economy. Once we pull the plug on that, stuff's going to get real for some companies when they're not maybe back, and they're going to start to have to open, and they're going to have to start paying their employees, and employees are going to have to start finding a job, and maybe those jobs, just from every side of it, the employees, the businesses, everyone's going to kind of have to figure out how to swim again.
Well, I like your analogy. I'd not heard that one before, but I mean, it's pretty good. It really is. What happens? What happens when that happens? When all of a sudden
Yeah.
the business guy has to get back to normal by hook or crook, and the government can't continue to just leave all these lifelines out there. And you didn't even mention the Federal Reserve and buying corporate bonds in order to shrink the spread, and then also even talk
Yeah.
about manipulation of the long term of the yield curve and just putting, for all intents and purposes, an effective ceiling on the long term bond. All of these things.
Yeah.
I mean, can this go on forever? And intuitively, you would have to think, no, it can't go on forever. At some point, the economy will have to swim on its own. And can it? And right now, I think that's just a huge question mark. I mean, a lot of industries are being impacted by this. Not just restaurants and retail, which are the ones people talk a lot about. And obviously, those are jobs that have been shed the quickest. But transportation, trucking companies, and then also obviously the airline companies and the cruise line companies, although they are all headquartered in Liberia, of course, and all of that. But there are a ton of industries that have been propped up, and it's not just the mom and pop coffee shop; it's any number of them. And if we can again only get back up to 50% revenue in some of these, we're going to see some more permanent job losses. We're just going to have to get used to a much higher unemployment rate. And if we have a higher unemployment rate, then you can imagine that we will see higher levels of delinquencies and mortgages. And that right there will obviously tie up some bank capital and slow down the extension of credit, meaning that any sort of recovery that comes after this will probably or could be a little bit slower just due to the fact that we just have a heck of a lot fewer people out there with a job. And what was the unemployment rate before all this went down? Less than 4%.
3.4, 3.5, and now we're some of the people at the Fed are saying the real unemployment right now is already over 20%.
And so let's say
bonkers.
let's say we get back to a level of 6 or 7%. What does that look like for a U.S. economy that is heavily dependent on consumer expenditures and the old C plus I plus G equation? If we have double the number of people not getting a paycheck, then they aren't consuming as much. And obviously, I mean, we can take the slippery slope down to a very worst case conclusion. I don't necessarily think it's a worst case conclusion. At the same time, you have to absorb what you've got, and then you have to think about what could be out there in order to come up with a macroeconomic forecast. And I think, Sam, you and I are in agreement that some of these people getting too unnecessarily fired up about the recent retail sales number and then also the employment situation report are hoping against hope that this will continue. And I hope it does too. I just think we have a lot of headwinds out there. I think the discretion is a better part of valor. I think it'd be wise to just hold on to any sort of massive changes in asset allocation until you can have a clearer idea of what the economy is really going to hold by the end of the summertime.
Yep, I completely agree.
So here we are in the middle of June. We're actually towards the end of June, and we've got all these lifelines to American business and to the American consumer that are out there. And the horizon is out there. The deadline's fast approaching. The money's drying up. And right now, there's talk about another stimulus package. What does that look like? Is there an extension of PPP? And I believe the Democrats are trying to get one, but it's going to focus more on much smaller and much more at-risk, employers. Then what happens when unemployment insurance runs out? And those are real dollars. Those are real dollars. And then you have a whole bunch of people that are getting kind of squeezed. And that's the people making $75,000 to $125,000, $150,000 a year. While that's awfully good money, and a lot of it's a very nice wage, it doesn't go quite as far in, say, maybe some of your northeastern cities as it would, say, here in Alabama or elsewhere. So these people, that might be exactly where the delinquencies are coming from, because they're not getting the PPP loan. Their PPP loans are maxed out at a certain level and all that stuff. So there are a lot of people still out there. Right. I think that's my point.
Yeah, no, I mean, that's hard to disagree. I think, the $600 goes a lot longer here, goes a lot further here than it does probably some other places. So
Probably a lot fast. It goes a lot longer here than it does in New York, but it still doesn't go as far as maybe it does in maybe some of your favorite places like a Wetumpka.
Yep, the place I frequently visit.
Yeah. That's an inside joke. So in any event, it's I'm laughing here, but we still have a lot of question marks, Sam. And for all the good news that we've had this month, occasionally some little report somewhere, some article, some newspaper clipping will kind of get you back to focusing on what the probable case scenario is. And the probable case scenario is, Sam, we aren't out of this. The probable case scenario is this is not a sharp V-shaped recovery.
Yeah, right. We're not out of the woods yet, and there's really not a good way to be able to tell until we start to take some of these programs out how strong the economy's been.
I think you're absolutely right. Gosh, we're not trading perspectives. I think we're absolutely on the same page here. Maybe we talk too much or something like that. I don't know. But, guys, out there listening, we're not trying to be depressing. We're not trying to, have the worst case scenarios. All we're trying to be is pragmatic and making sure that we invest our clients' money as wisely as is possible, and then you don't go running back in just because you have a couple of good headlines. There's a lot of issues here at play, and a whole bunch of it revolves around what does the economy truly look like once we get the lifelines out of the way. And right now, I don't think anyone can tell you with 100% certainty exactly what that is. Sam?
Yep. No, completely agree.
All right. Well, guys, thank you all so much for listening. We always love to hear from you all. So if you have any comments or questions, please drop us a line at tradingperspectives@oakworthcapital.com. Also, if you want to hear more or read more of what we have to say or think, you can always check out our blog at our website at oakworthcapital.com underneath the Thought Leadership tab. Sam, I'm going to give you the last chance.
That's all I got.
That's all I've got today, too. Y'all take care.